Hello. Welcome to Breakwave Day. We hope you enjoy our event.
Hello, and welcome to our Breakwave 2024 event. I'm John Carchonas, founding and managing partner of Breakwave Advisors. So this is our fourth annual event, and it's remarkable what has the last 4 years been for global shipping. So this morning, I went back and looked at where the stock price of BDRY ETF that tracks dry bulk futures was on our first Breakwave day in 2020. And amazingly, it was right about where it is as we speak. Yet, unlike the uneventful optics of such a static, the past 4 years has been anything but uneventful. In fact, we have experienced some of the most unforeseen and dramatic events of our century. 2 wars greatly affecting commodity flows, the 2 major world seaways, namely the Suez and Panama Canals, effectively closing for prolonged periods of time, and obviously the biggest of all, the early effects of the pandemic. Shipping has greatly reacted to all of the above, but as a deeply cyclical industry, it is the very distinct cycles that matter, when supply and demand gets out of balance, only temporarily, and always find ways and returns to equilibrium. So today, the obvious question is whether we are at another important inflection point for shipping, given the recent volatility. Our event aims not at predicting the future, which of course is impossible, but at providing views and opinions from the people who focus daily on shipping, so each one of us can form his or her own opinion, whether such arguments are valid and how to react to developments when they arise. After all, in commodity shipping, no one has any superior information, and shipping is one of the most even play fields in the commodities world. So over the next few hours, you're going to hear views and opinions relating to dry bulk and tankers from some of the brightest minds in the industry. Today's event is part of such effort, which combined with our regular publications and frequent updates in our Insights website, should hopefully continue to add value to the investment process for such exciting industries for all of us to invest and trade. Before we begin, I'm going to mention that this is a live event, so I would like to apologize in advance for any mishaps during this broadcast, which include presenters and participants from around the globe. So now, with no further delay, I would like to introduce our first segment that focuses on the current state of the dry bulk market, as well as the outlook for the years ahead. We're very excited to have with us our first presenter. As a global head of dry bulk research at Braemar, Derek Langston has provided some of the highest quality research in the industry. Regular followers of Braemar research will know how detailed and to the point Braemar publications are, and will always read what they have to say very carefully. And with that, I would like to pass it along to Derek from Braemar to provide us with his views on the space and his outlook for next year. Good afternoon, Derek from York. The floor is yours, and please go ahead with your presentation.
Thanks, John, for a very nice introduction. It's a pleasure to be here, and hello, everyone. Today we're going to run through a presentation, which is the dry bulk freight market outlook. The first thing we're going to talk about is the longer term context, where the dry bulk market is in the current cycle. So a bit of a longer term look. Then we're going to run through the drivers in 2024, talk about the outlook for 2025 at the end. So if I can go into the first slide, please. So longer term context, and the first chart coming up is on the Baltic Exchange Dry Index. Can I have that slide, please? So what we have here, picked out the highlights over approaching 20 years of history. Everyone likes to have a look at the highlights of the past. You can see there, picked out three major ones. Now, when we're looking at the three major ones, I think there's something really of validity, something still relevant today in each of these three high points. The first one there, we're looking at the global financial crisis, the period leading up to that, 07 and 08, when we hit record levels. Now, at that time, the China import boom was a big part of that. Undersupply really through lack of shipbuilding capacity really to keep up with that. So that idea there, the China import boom, still very much relevant and with us today. The next one you see, China stimulus. After the crash that we saw in the end of 2008, in 2009, 2010, the stimulus package, 4 trillion yuan on very steel-intensive projects, such as post-earthquake reconstruction and so on. Still, again, very relevant today. You go through a bit of a lull there in the mid-2010s, a real dip in the market, but then we come back in the COVID-related time, and that was a time of great fleet inefficiency. And the idea of inefficiency is the one, again, we really need to focus on when we're looking at today's market, when the avoidance of the Red Sea, thanks to the Houthi attacks, the Panama Canal restrictions for much of the first half of 2024 also had a bearing. And if you could just click one more on there, please. I think we'll get this red circle appearing. That is today's market. So having a look at where we were in 2024, yeah, we bounced back from the lows of early 2023. The market has pushed up, but those of you with very good eyesight, you can see right at the very end there, a bit of a downward move over the last couple of months. And the question is, as John said, is this coming up to an inflection point in shipping? So could I have the next slide, please? And what we have here, if you had to ask really for evidence of the role that China has played in the shipping market over the last 20 years or so, these are two slides that give you really concrete evidence of that. On the left, you can see we've just taken minerals. We were ignoring the grains that China's imported, the soybean volumes, which have risen as well. Just focusing on minerals here, iron ore, coal, and some of these other ores and concentrates, most notably bauxite, large volumes really helping to drive the Capesize market in increasing ways over the last few years. But you look at that, really, it's an extremely vital success story for dry bulk shipping. If you compare that as well with crude steel production, that's gone up similarly. It now China dominates the steel production space around the world. But if you have a look there at both the top, if you take a look at the steel production, it has been flattening. It's come off a peak. It's been flattening. It even looks like it'll be slightly lower this year. When you look at the imports on the left-hand side, you can see there that really the coal volumes and the bauxite and the iron ore, that seems to be a bit counterintuitive. They seem to be rising again. So that's another question that we have. Have we got to an inflection point? And what about what's happening in China? We're getting iron ore import growth with steel production falling. An important question. We're also seeing, again, some massive numbers of coal imports coming in. Now, with Chinese coal, as we'll see, really, it has a very, very large production base domestically. So these kind of minor changes in overall domestic production have a big bearing, as do competition with other fuel types. But this really has been another driver. So can I have the next slide, please? Thank you. Now, when we're looking at that chart on China, you'd be thinking, well, why haven't we had these strong rates all this time? And of course, the answer has been the fleet supply response, the new building ordering. And you can see really what's happening at the left-hand side of the chart. After the boom market, we had a whole load of orders that still had to be processed. And even once freight rates came down, these new building deliveries, the massive jump in fleet supply really helped to push the market down through into the middle of the decade. What's interesting about more recent times, and something that happened in the last kind of bull market, as we saw around the fleet inefficiencies of COVID, around 2020, 2021, early 2022, was it didn't trigger the same response in terms of new building deliveries that previous cycles have done. So the orders are there. The orders have been building up more recently, but we haven't had the same trigger in terms of supply side response that we've had in previous cycles. Can I have the next slide, please? So looking at the current state of the market, and next slide has the Capesize and Panamax markets, a seasonal view. So if you click again, we can have the Capesize market first of all. In this seasonal view, January to December. In red, we have the Capesize market. And as you can see there, strong start to the year in Q1. Some very positive stories in terms of Capesize trades from the Atlantic into the Pacific. We'll talk about a bit later on. But things beginning to fade a little bit in the Q4. Sometimes in the past, we've had that bit of strength, but beginning to dwindle a little bit there. The next chart, I think, we have Panamaxes. And you can see, again, strong start to the year, not quite as headline strong, not one of the strongest that we've seen in the Capesize market, but in the last couple of months beginning to dwindle. And that's now becoming one of the weaker markets at this time of the year. Now, if we go into our next slide, and if you click again, please, for Supramax and also for Handysize as well, another click, you can see there the comparison with the geared sizes. So the Capesize market, the largest size, 180,000 deadweight. Panamax, more a mid-size. Now we're looking at the performance there of the smaller sizes. And you can see there the red line showing that we've really been between two boom years in the past when the COVID-related inefficiencies and then two weaker years either side. So next slide, please. So we've got the 2024 drivers, what's been driving this. So taking this bullet point by bullet point. So number one, we have looking at the fleet inefficiencies, first of all, Red Sea being at the heart of that. And when we looked at the avoidance that we see by most of the ships, we've calculated that in terms of extra distance, this has then created an extra 2% on distances, on ship demand. We call it ton-mile demand. And that's across the entire dry bulk market sector. Now, 2% globally does make a massive difference. It does really matter. It stops the ships becoming free, so available, and helps to support the market. The next bullet point we have is that we have fewer long-haul Panamax grain shipments, and that has been after what's been generally been quite a good year. But compared to this time last year, we're not seeing as much in the way of long-haul Panamax shipments of Brazilian corn going to China and other countries in East Asia. And that combined with very much a lack of port congestion that we did see at the beginning of, say, the first half of 2023, that combination there really has meant that the Panamax market in the South Atlantic has had nothing like the amount of support that it had previously. So that has been something that's turned from being quite positive into something that's becoming more negative. The next bullet point was mentioned that we've got a record year for China's coal imports, and we've had a rise as well into India, although sometimes domestic production growth has actually prevented some of that rise from being higher. The next bullet point, we have Capesize trade expansion has been on the long-haul trades from the Atlantic into the Pacific. That's been a mixture of trades. That's also been a positive. And then the last one we've had, and this really enabling some of the iron ore growth from Brazil, some of the iron ore growth from Ukraine, which has restarted on Capesizes, that despite falling steel production, our final bullet point, China's iron ore import growth has been supported by increased steel exports overseas, but also by iron ore stock build. So those two drivers then, the increased steel exports, helping to support some of the iron ore demand into China. But also there has been an increase in stocks. And the question there is, how long can this continue to go on and support iron ore import growth into China? I'll have a quick look now at a couple of slides just to back this up. First of all, the fleet inefficiency slide. Firstly, on the left, we have the Panama Canal, and you can see there that the restrictions with low water levels, how that really has created a massive, drove away a lot of transits from late 2023 into early 2024 when water levels recovered. So we have a bit of a normalization going on as well. But in the slide on the right shows, when we're looking at the Suez Canal, you can see there that what we had with the Panama Canal closure was an increase in vessels, say for loading US Gulf, going into markets such as India and taking pet coke. Then you would normally, your next option would be to go through the Red Sea. But because of what happened with the Red Sea there, with the Houthi attacks, then the Red Sea started to be avoided by quite a large number of vessels. So what you can see in this chart on the right is that increase in volume going through the Red Sea, then followed by a decrease there. So looking at the Suez Canal transits, not everything going past Yemen, but you can see what an effect that has had. So vessels are still passing through, but they tend to be from areas such as the Black Sea on the way down. So having a look at the next chart, please. That's the Brazilian port congestion. And as I mentioned, I think this chart is one of the key charts for looking at supply-demand balances at the moment in the Panamax market. As I mentioned, Panamaxes have been at the heart of the weakness in our view. And what we had at this time last year was a massive build-up in queues. Now, this is just really counting ships, nothing more sophisticated than that. You expect to see vessel queues at the first quarter or so, second quarter of the year, when Brazil's soybean exports get going. We're looking at the second half of the year, when looking at corn exports. Normally, and this year's been fairly typical, you don't have that level of congestion, but last year you did. So when we're doing a comparison with this year in 2024 and last year in 2023, you can see that there are almost 100 fewer Panamaxes in queues in November compared to that same time last year. And in conjunction with fewer loadings that were going on at the same time, that has created a real swing effect. And that drop in Panamax demand in the South Atlantic isn't being met elsewhere. And we're seeing that Panamax market beginning to decline. Yes, Panamaxes are more involved in US coal. Yes, you can see them being used elsewhere on the coal trades, but we're sort of missing that's been quite an important swing factor for us. And the chart on the right-hand side shows the impact there on the geared sizes as well. They're also beginning to diminish too. So the kind of weakness in that market there is beginning to be felt across different sizes. So now we move on to another chart. This one does show the volumes out of Brazil. And if you're looking at that, there's no real sign of any weakness. But as the next chart will show, we're focusing here on the long haul shipments, which are mainly Panamax market. You can see there are a lot fewer in the way that are moving. So what we've got is also that congestion effect, the inefficiencies, plus also there's less demand at the moment for corn from Brazil into China. And also some of the agri-analysts are forecasting a little bit less demand as well from China in 2025. So that kind of effect, it looks like we're feeling that already in the market. Next slide, please. And then we're looking at some of the massive growth stories in coal. Now, this really is impacting Panamaxes, but also Capes and smaller sizes as well. And one of the most impressive growth stories you can see here is Chinese coal imports. Huge volumes, mainly thermal coal. The coking coal demand is strong, but mainly thermal coal. And this really does, as I said, been influenced by perhaps more safety controls on Chinese coal production, more under control. There's less of a discount for domestic grades, sometimes against imports. That does have an impact. Hydropower, those kind of features. There are also stockpiles as well. It's a real mixture of factors driving it. But we're also seeing as well more long-term deals being done, more long-term contracts on Chinese coal, which is also meaning it's less susceptible sometimes to swings in fundamentals. Can be very volatile in the past. Sometimes when we see fundamentals change at the moment, some of those long-term deals are in place and it doesn't seem quite so volatile. So very strong volumes into China. And as I mentioned as well, we're seeing that in India, where the demand story is very positive. So next slide, please. And then looking at two of the major growth stories and focusing here on what's happening in Capes is the growth in bauxite from West Africa into China. And you can see on the left-hand side, the volumes there have been coming in from Guinea, how really have since 2015 are spiraling higher. And one of the big positives, and it's also changed, as well as being support for Capes, it also changes the seasonality. So in the Q1, when iron ore trade is typically a bit lower, sometimes you can have that. That's one of the stronger times of year from Guinea. And also conversely, in the Q3, that's sometimes when you see some of the rain season, the wet season in Guinea impact volumes there. So it's beginning to distort a bit of seasonality as well. And the other driver that we've seen from Cape sizes from the Atlantic has been Brazilian iron ore exports, and they've been just now getting back to the level that we saw before the Brumadinho dam disaster led to several safety checks. So what you've got from the Atlantic to the Pacific is 4 positives, those 2 charts, plus the return of Ukrainian iron ore and also coal from Colombia, which has been pricing into Asian markets. Next slide, please. So looking at the outlook, and first of all, yeah, we can have the text as well on the left, thanks. Thank you. So what we have here is really a look at our global trade. Now, this is just in tons. We're not looking at ship demand here, but it's just as purely volume terms. What's interesting is you can see there that in 2021, which is a much stronger market, it's not, yes, trade growth was positive, but we had a lot of fleet inefficiencies, COVID-related, quarantining, crew change requirements, and so on. That did have quite a big effect in pulling the market up. Looking at 2023, a far better growth story in terms of trade, but actually didn't have the same level of fleet inefficiencies. Funnily enough, now we get a better market in 2024, and actually when trade growth isn't quite as strong, that's when we see this market picking up again. So I think what this chart is good at doing is also explaining our thoughts on the market, but also at the same time really reminding us that fleet inefficiencies are a big part of the story. And the Red Sea avoidance, which is still there at the moment, even though Panama Canal is back, is part of that fleet inefficiency story at the moment. I think there's one more bit of text to come. Thanks very much. I think we'll go on to the next slide, if we can, please. Then looking at the fleet growth story, first of all, on the left-hand side, we've got the additions by year in green. All of this is in million deadweight tons to give the volume of cargo capacity. In the black, we have deletions. So you can say that's mainly demolition, but also any losses that have been at sea at that time. And then you can see there, yeah, that looks a fairly steady, stable picture going into 2025. But the chart on the right really makes a distinction between the Capesize market that you see there, where you have a potential for lower fleet supply growth in 2025, and the other sizes with, for example, we expect to see more Panamaxes arriving, Kamsarmaxes arriving next year, and also to the other one, that distinction that you can make between the two is really being flagged up in this chart. So that is quite significant for us. And can we have the next slide, please? The risks to the outlook. So when we're having this, of course, we can have a view on the market, but of course the risks to the outlook are numerous. Firstly, we would say that Red Sea inefficiencies are still there, but that normalization in the Panama Canal is sort of adding to the fleet supply. It does sort of help with fleet supply around the world globally. Grain trade, possibly to retreat. That's what's being flagged up by analysts such as the US Department of Agriculture and the International Grains Council, among others. And with some of that demand from China, and we're seeing that at the moment, a little less buying interest for corn currently. There's a lot of weather to happen between now and then, and we've got to remember that that weather does have a big part to play in either affecting production in importing countries or exporting countries. So there's risk attached, very much attached to this one. There could be upside to our forecast that we had for 2025. We've been underestimating Chinese coal imports for 2 years. We could have growth again in 2025. That would then mean that the current outlook for the market would be a bit brighter. And there's a possibility of trade wars, of course, with a new administration coming into the US. Last time we saw that the target was mainly steel going into the US, but also we had retaliatory tariffs of, for example, China on soybeans from the US, and that was quite an important tool. Iron ore appetite, I would say, maybe have a bit more conversation about that in the panel, because it is interesting at the moment. We've got this steel export story, which is helping with that. We've also got a build up in stockpiles. So that would be one. Is there a danger that that's going to run out of road and that we're going to see slower growth in iron ore in coming months? And then, of course, the one that's very difficult, impossible to model, is the unexpected port congestion or disruptions. That's the one that you cannot really foresee, but we can see how important those ones are. And then finally, when we're looking at fleet supply growth, it's important to note there that geared bulkers will see the fastest net growth in 24 and in 2025, but Capes the slowest. So when you're looking at something like the Braemar screen, and we're looking at the Cal 25, how that's being priced at the moment, it's 18,500 for Capes. We're looking at Panamaxes, we're just under 12,000 if we're looking at a kind of an 82 equivalent. Supers at around about $11,000 a day. These risks to the outlook, that's very much sort of in price the market. We would say that these are the ones that could move that picture over the coming 12 months. So thank you very much for your attention.
Thank you, Derek. That's extremely interesting. Now, this is something we're going to discuss later in our panel, but obviously looking at the Capesize segment, which is the largest bulkers out there, most of the year has been relatively stable. Now strong, but not a lot of volatility. And then 3 weeks ago or so, the whole thing just collapsed. I mean, Capesize rates are down 50+%. Panamax have been weaker, but they haven't moved much. But what do you think is happening here? I know it's a difficult question and it's a very current. We don't have a lot of data, but what is your best guess of why we had such a weakness in the last 3 weeks?
Yeah, I mean, I think really go back to the Q3. We did have quite a strong end to the Q3. We had rates, the 5TC average was pushing higher. We had a succession of typhoons sweeping across Asia, sweeping into China, causing vessels to move out of port and so on. The Capesize market was in quite a strong position. And that's really, when I think our expectations for the Q4 were encouraged by that development. But also that made Capes, of course, very strong relative to Panamaxes. And I think after the disruptions, after the loadings, the discharging disruptions around China, at the same time, really a lot of Panamaxes that were more competitive than, say, for example, Australian coal stems. And that really led to ballasting Capes in huge numbers, according to our figures, some of the highest numbers ever, away from the Pacific market, where they were struggling to find sufficient cargoes, into the Atlantic. And that really, at the time of the Atlantic, there was a couple of issues, sometimes small issues on the supply side, but really quite quickly that became overwhelmed. And we saw a very, very sharp downward adjustment over that period. So really a function of the flow between the Pacific and the Atlantic market currently. And what we're seeing really in terms of overall volumes, I think this is one really for a bit further discussion, is in terms of some of the iron ore appetite, is that beginning to, currently we're not seeing quite as much activity on a global sense. Maybe that, as I hinted at in the presentation, is that something that's beginning to, is fairly steady demand. It's not we've got the run up to Chinese New Year. That tends to be a bit more in the way of buying interest at the moment, but the interest seems to be fairly steady currently. And we also, as I said, we're looking at some of the areas such as US, has been strong for US coal and carried in Capes into markets such as India. See way more involvement on Panamaxes these days. Not quite such much there. And sometimes with shipping, it can be that. It can be kind of these fairly small margins can have quite a big effect. The Capesize market is extraordinarily volatile. We've learned that in years. That sometimes you think a market can get there in about a couple of months, and then it happens in about 3 days. And such is the volatility in the Capesize sector. And I think that sometimes in this market, it doesn't take that much in terms of an S&D change locally to have to produce quite a big move on rates.
Absolutely. And I guess that's where the opportunities come in shipping. Now, last question, and I'm not going to let you go without answering that. 18,500 for Capesizes for next year. What is your view? Low, high, right about where it should be?
I mean, as I said in the presentation, I mean, the risks to the outlook are there, and that's would be my health warning that I would put on these comments. Yeah, I mean, that would represent. We're kind of looking at the year to date from 2024. We're looking at somewhere just, I think, just over $23,000 a day currently. So that would be quite a big downward adjustment. It also, I think that the Cape-size market, although in a lot of ways it has quite a positive fleet supply story in the sense that there's not a huge amount coming in, there is also competition. You see that from cheaper Panamaxes. If the Panamax market is struggling, as it has been, then there is a bit of a downward pull. Certainly the upside for Capes does get a bit more restricted. And I think that's what's led to this move now below $20,000 a day for the Cal 25. So yeah, I would say that is that's where some of this is being headed. But at the same time, and I think I mentioned this in the presentation, when we're looking at upside potential, I would sort of flag up again Chinese coal imports. That would then also have a benefit across the board, across different sectors. That may be something that we are underestimating again for 2025. And if that's the case, then you can get that bit of upward movement could return.
Understand. Excellent. Thank you very much, Derek, and have a great afternoon.
Thank you, John. Thank you very much for the invitation.
Absolutely. So as I've said before, I think it's very useful to see how people who receive real-time information in shipping and the commodity markets think about the outlook versus most of us who probably process such information on a second-hand basis. So with that, we'll be back with our first panel of the day in 15 short seconds. Welcome back. So our first panel of the day also contains some of today's top analysts in the dry bulk space that, similar to Derek, also receive and process first-hand information and thus can speak about their views and outlook for dry bulk shipping as they see it from their respective positions. So today for our dry bulk panel, we're very excited to be joined by Liz Gao, who is a senior research analyst for iron ore at CRU, and is joining us today from Singapore. Serena Piaggio, dry bulk shipping and commodities analyst for IFCOR Galbraith, joining us today from Genoa. Burak Sedinok, head of research at Arrow, who is joining us today from London. And Jelf Landsberg, president of Commodore Research, joining us today from San Francisco. So welcome to all. So let's jump straight into our discussion. And my first question is going to be for Burak. So 2024 has been a remarkable year in terms of shipping-related events. We had the Red Sea passage that has been effectively closed now for a year. We had the Panama Canal in the first half of the year that, due to lack of rain, was very slow. And these are some very extreme disruptions for all shipping. Yet, as you look at across commodity shipping, one have assumed that nothing really meaningful has happened. I mean, yes, we did have some stronger Cape-size rates, especially in the first quarter. But again, we're talking about some major disruptions here, and they continue even today. And yet the Baltic Dry Index, which is the main barometer for dry bulk shipping, sits at an 8-year low today. And it's going to average even less than 2,000, which is not particularly exciting. Now you look at the last month, as we said before, for Cape-size rates down some 50%. Panamax spot rates are down in the single digits. So again, I'm going to ask the same question I asked Derek. What do you think is happening given all the tailwinds we had this year? Why the market is not much stronger, and why it hasn't been much stronger this year?
Yeah, thanks. Thanks, John. I tend to agree with Derek's prognosis. Really, we've recently, especially, we've lost some of the long haul trades, especially on the grain side. Now, some of the longer haul coal volumes are down as well. But for me, I think that primarily, especially for the smaller ships, and I'm talking about Panamaxes and below, I think it's been primarily a supply side story, really, a supply side issue. We've had effective fleet growth of about 6%, which is, historically speaking, it's quite large. I say effective fleet because this is not just deliveries and demolitions, net additions. It's also that effective fleet growth also includes the changes in congestion. And Derek very nicely presented, we have a very, very low congestion, especially in the Panamax market right now. And that's released a lot of tonnage into the market. And I think that's combined with the loss of some long haul tonnage is what's causing the pain, especially for the Panamax segment. And because of the spread, Panamax are now cannibalizing other segments. If you look at the geared segments, Ultramaxes and handy sizes. On certain trades, Panamaxes are now cannibalizing, geared trades. I mean, an unusually large percentage of the Panamax fleet is currently trading minor bulks, which is normally the bread and butter of the geared segments. For Cape sizes, I think, I mean, especially the recent volatility I think has a lot to do with sentiment as well. Yes, we've seen the fundamentals somewhat softening. Panamax is again cannibalizing some long haul coal trades, stealing coal cargoes from the Cape size market. But really, I think this extreme volatility in the paper market, the repositioning that we saw last past couple of weeks, really, is really having a big impact on sentiment. I think that's also having an impact on the physical as well at this point.
I see. So, I mean, again, the supply side in dry bulk has been something that has been talked about. So you think that because of the smaller sizes, that's also affecting the overall market, I guess, right?
That's correct. I mean, especially if you look at this when we talk about the increase in effective fleet supply, it's really concentrated in the smaller ships like Panamaxes and below. Whereas if you look at the Cape size market, actually, it's been pretty benign. I mean, we've had less than 4% growth in effective fleet, which is very, very manageable. And it's quite a low level from an historical point of view. But if you look at the other extreme of the market, the weakest link, Panamaxes, where we've seen in excess of 8% growth in effective fleet, which is from an historical point of view, it's quite large. So that's really, in my view, one of the primary problems that's caused this weak freight environment.
All right. So I want to look a little bit in the near future now, and we're less than a month away from 2025, and it might be a year that one can say is a return to fundamental story, as we talked. From a pure balance perspective here, and given the current weak freight environment, I want to talk about how do you see next year, and I'll ask Serena on that first. What do you think are the major factors that will affect early next year and the whole year as a whole? Do you think, again, it's a fundamental story? Do you think all these disruptions we had basically don't matter? What do you think, Serena?
So, thank you, John. Thank you for the invitation, first of all. Well, starting with what can go right, we have a positive bias on the Cape size market next year because we expect, as Burak was mentioning, we expect the slowest fleet growth of the entire dry bulk sector, together with expanding demand. Indeed, Cape sizes are designed to transport minerals such as coal, iron ore, and bauxite. Iron ore is actually the most important commodity, representing the 65% of Cape size demand in terms of what we call ton miles. And on iron ore, we expect all major origins to push exports next year. So we're talking Brazil, Australia, and a new player, possibly Guinea. I think it's worth to mention that the Onslow project in Australia has been an incredible achievement this year and is expected to ramp up exports in 2025. And it's also worth to mention Simandou project in Guinea. It's a really huge project that has been developed over the last few years and finally is set to start exports in 2025. So the picture on iron ore is positive. Guinea is not only important for iron ore in 2025, but also historically is the top bauxite exporter globally. So we see potential for exports growth in terms of bauxite as well from Guinea. And keep in mind that every ton sailing from Guinea to China is especially important for Cape size because it's quite a long leg, which is keeping the vessel busy, the vessel employed. and therefore important in terms of ton miles. So if you ask me what can go wrong next year, I can tell you anything, any issue in Guinea, I would say, that prevents or suspend or slows down exports. Any issue would be negative for Capesize freights. And let's also keep in mind that the rally on Capes might also be limited by the fact that this new project, Onslow in Australia and Simandou in Guinea, will use transshipment. So a window of opportunity for arbitrage with smaller vessel sizes may open. So what can go right on Panamax can actually be bad for Capes in this respect. Another bearish factor could be China reducing coal imports. They are trying to make domestic production more profitable in order to be able to reduce their reliance on coal. And last but not least, I would also mention among the bearish factors the fact that steel exports may reduce, and this would be negative for the smaller sizes. So from handy size to supra ultra, I would say.
All right, so I guess again, Cape sizes are there to save the day, I guess, or outperform. But since we're on China, I want to turn a little bit to Liz, and it has been following China very closely for many years now, obviously, and iron ore steel are the drivers for dry bulk shipping in the long run. Now, remarkably, iron ore imports into China will end up being up something like 5%, and yet steel production, which is basically the industry that uses iron ore, will be down something like 3%. Now, as Burak said before, or Derek said before, iron ore inventories are piling up in the ports, and probably that's not a sustainable situation. So, Liz, turning to you, can you please tell us a little bit about what's going on in China in terms of the steel market and the relation to iron ore imports? I mean, to me, it seems quite puzzling, 2024, and I'm sure you have looked closer into what's going on, but why this mismatch between imports and steel production, and what do you expect for next year?
Thank you, John. And something I agree is that it's been a tough year for China's steel industry in 2024. Because one thing that stands out, I think both Derek and Serena mentioned, is China's steel export. We have seen a quite notably year-on-year increase compared to that in 2023. But when we look at the domestic demand of steel, it's a bit of a different story because there are some changes in China's steel demand in 2024. For example, manufacturing sector is becoming the primary driver of steel demand, surpassing the conventional construction sector. And there we have seen some support from different sectors, like from automotive, from home appliance, and renewable energy, shipbuilding sectors, but all of those is supporting the flat products. On the other hand, the infrastructure investment faced some challenges because of the local government debt issue. And then I don't want to comment too much about the housing market because it just continues a declining trend until now. So I think that's why Chinese government introduced a series of stimulus measures to deleverage the local debt issue and then to destock the housing market in China. But from our perspective, we haven't seen any significant impact to steel demand from the stimulus measures. And moving into 2025, we think there will be more headwinds in the steel industry in China. First of all, lackluster domestic demand, and then, like Serena mentioned, export may face some challenging scenarios due to the potential tariff. But something to watch for is the two sessions meeting in March 2025. So any major policy shift may lead to significant impact to the steel and iron ore industry. Speaking about iron ore, yes, I agree. China imported a lot of iron ore this year, but most of them are low-grade iron ore, which means you produce the same amount of steel. You need to charge more iron ore if the average Fe content is lower. And then at the same time, I think Derek mentioned in his presentation that the port inventories will keep piling up, roughly around 30 to 40 million tons higher than the same period of last year. In CRU, we actually have our own methodology to track the whole supply chain from the downstream demand and consumption all the way to the upstream raw materials production. So in our data sets, the balance of the iron ore import and crude steel production doesn't look that concerning at this very moment. Thanks.
So you think that probably you're looking at a flattish type of steel demand for next year, or is going to be another down year in China?
Overall, steel demand will have a marginal decline in 2025. That's our view.
All right. Excellent. Great. So we're in iron ore. I want to turn over to Jeff and ask him about iron ore, but I know he's a proponent of a strong China in terms of iron ore imports, but also I want to talk a little bit about coal. And coal is obviously a forgotten commodity in the Western world, but is thriving in Asia. Trade is growing there, and for now, there is no real alternative. So, Jeff, what are your thoughts, just briefly on iron ore, and then please on coal, and obviously China?
Yeah, hi, John. Yeah, so with iron ore, we've always taken the view that China is happy to purchase as much iron ore that global miners want to produce and export. We've never really seen China turn away from buying imported iron ore cargoes. To us, the question is always, well, will the global iron ore exporters want to continue to produce? And so with iron ore, what we continue to see is that as long as spot iron ore prices are high enough for the global iron ore miners, then they will produce it and they'll put it out to the export market. And then year after year, China has showed that they're happy to import really each and every cargo that's available. The question is just at what price, but if it's available, they'll purchase it. And of course, they're happy to get it at cheaper prices. And so that's why, even though the Chinese housing market is incredibly weak, we've always predicted that Chinese iron ore imports are going to be robust. And so far, it's continued to ring true. So we're very bullish for China's iron ore import demand. And our question is always, well, if the iron ore producers want to produce it. And so we'll see. We'll see how iron ore prices fare going forward.
All right. And how about coal? I know that you're a lot focused on what's happening in China and coal and the renewables versus coal. What do you think we'll look for 2025 there?
Yeah, sure. So with coal, this year, China's coal import demand, their coal import demand has been great, but China's coal-derived electricity production has been good this year, but not great by any means. Last year, China's coal-derived electricity production grew year on year by 6.5%. Very, very strong. This year, when all is said and done, we expect that the growth will come in at 2.5%, which is much lower. It's still decent, though. Next year, we think it's going to rebound to 3.5%. As far as renewables are concerned, so there is great growth in Chinese renewable sources of electricity production, particularly solar and wind. Again, this year, China's coal-derived electricity production is going to grow year on year by around 2.5%. If you look at solar's growth this year is 35.5%. That's huge growth. Wind is 14%. Nuclear is only 3%, and hydro is 9%. So even though renewables, the growth is so strong, the total production derived from renewables is still very, very low. China's coal-derived electricity production is about 17 times stronger than solar power production. It's 14 times stronger than nuclear power production. It's 7 times stronger than wind, and it's 5 times stronger than hydro. So if you look at solar, even if solar is growing 35.5%, it's still such a small number. So renewables is really only having a small dent on China's demand for coal and how much thermal coal they burn to produce electricity. What's actually most important to us is hydro and rainfall. And so what's interesting is that China's coal-derived electricity production grew last year 6.5%. That was really great growth. The previous year it grew only 1.5%. But why was China's coal-derived electricity production growth so strong last year? The reason it was so strong is that hydropower production contracted year on year last year by 5%. And the reason it contracted is because China, and particularly the areas where there are a large amount of hydro stations, received much less rainfall than usual. So you had hydropower production in China contracting last year, and you had coal-derived electricity production growth surging. Now, flash forward to this year, how has rainfall and hydropower production fared? China has received a lot of rain this year, and when all is said and done this year, China's hydropower production will grow this year on year by 9%. That's the strongest in at least 7 years. So because China's hydropower production growth has been so strong, coal-derived electricity production growth this year is going to come down to 2.5%, again from 6.5% last year. So what's actually most important for us looking forward and looking particularly near term is really just rainfall and how hydropower production fares. Overall, though, China is continuing to produce a record amount of electricity. That's not going to change. They're continuing to produce a record amount of coal-derived electricity production. That's also not going to change. But again, a lot comes down to rainfall and hydro. I do also want to add briefly, though, that because China is in the midst of a really significant a switch over to really adapting to and embracing electronic vehicles, that's actually great for conventional sources of electricity production, including coal-derived electricity production. Instead of cars that are just being filled up with oil, instead EVs have to tap into China's power grid, and the grid, by and large, is still fueled by thermal coal sources of electricity. So, ironically, as China shifts more and more towards embracing electronic vehicles, that's actually beneficial for coal. So, so that's definitely good. But I do think that we'll see a rebound in China's coal-derived electricity production growth next year.
Yeah, that's interesting that we're going to the EVs, but at the end of the day, it's coal that's powering these EVs. And the other interesting thing is that weather continues to play a major role in dry bulk, whether it was the Panama Canal or obviously hydro power generation. So I want to turn to a different subject now and talk a little bit about tariffs. And obviously, every day for the past several months, anyone who is reading the news reads something about the upcoming tariffs. So dry bulk is obviously part of global trade and should be affected to some degree by tariffs. So I'm going to turn to Burak and see what he thinks about this tariff narrative and how relevant it is for dry bulk. And then I will turn back to Jeff a little bit about geopolitics. So Burak, first on tariffs, what do you think? Does it matter?
Well, yeah, it does matter. But before I, comment on the tariffs, I just would like to add one thing to Jeffrey's comments, which I agree basically. When it comes to China iron ore story, we are talking about nominal terms, but I think a lot of people actually actually forget that China is now a major iron ore exporter in the region as well. So far this year, they've exported 19 million tons of iron ore. And that's because most major miners actually have blending facilities in major ports in China. And by the way, that 19 million tons puts China on the 7th largest iron ore exporter in the world. So what I'm getting at is all this blending actually, exercises, blending activity requires some iron ore as working capital. So it's actually normal to have that 150 million tons of iron ore that we're talking about, some of that, which we estimate at around 30 to 4 million tons, 40 million tons, is not to be consumed. It's used as working capital for blending purposes. So that's one thing. And one short comment on coal. I completely agree. I think coal demand in China. China burns a lot of coal, roughly about 4 billion tons a year. We're talking about growth in coal demand or imports declining by about, or coal burn declining by about 2.5%, but that still means 100 million tons of extra coal because of the high base. So I think, there are different dynamics at play there. Anyway, going back to your question, just as a footnote, I just wanted to add those. Yeah, tariffs are interesting, right? I think obviously it will have an impact on global trade and dry bulk as well. Although I think dry bulk is less exposed to tariffs compared to some of the other sectors. The way I see tariffs is it's slightly against the consensus. Ultimately, I think what the tariffs will have is it's going to create big price differentials, and arbitrage windows open, and traders will find a way around these tariffs to make upsized gains. That's what we've seen back in 2018. If you remember, during the first round of trade war between US and China, basically President Trump announced blanket tariffs on Chinese goods or Chinese imports. Then China said, okay, I'm not buying soybeans from the US farmers. Then what they did was they turned to Brazilian farmers. They bought everything they produced and everything they had in stocks. US grain prices collapsed. Then Brazilian traders took advantage of that and purchased US grains for domestic consumption. So in the end, what happened was ultimately similar amounts, if not slightly higher amounts of grains were being traded in a much more inefficient way. So, and that actually had a slight net positive impact on ton-mile demand. So, the way I see this tariffs going on, obviously it's this time around, it's a little bit more complicated. Many more countries are involved as well. Basically both China and the US is exerting pressure on friendlier countries to choose a side in a way. So how it's going to play out is a little bit more difficult to predict. But I think, again, ultimately, the way I see the timeline of these things is, I think we are already starting to see, some of the US importers are front-loading their purchases ahead of tariffs. So that's bringing future demand forward. And once tariffs are in place, whatever that may be, we will probably see a sharp decline in demand. But then we will start seeing these big price differentials forming, right? Arbitrage windows opening. And that's when we will start seeing new innovative trades, new, let's say, diversions taking place, and volumes will will slowly recover. So I think ultimately, I think the way I see the impact of these tariffs on dry bulk trade is a lot more volatility. But we could, depending on how harsh these tariffs or tit for tat measures will be, we will see trade recovering and trade happening in a much more inefficient way. That's my view. But who knows? It's a very complicated subject.
Absolutely, it is. We're a little bit tight on time, so I want to touch on two things very quickly. First of all, I want to ask Serena something about supply and something that can be very topical, especially in the first quarter of the year. So obviously, we all know about the order book and what will be delivered. It's very easy to pick up a research report and read about that. One thing I've been hearing of the industry has to do more with the age of the fleet and how many ships have to go to the shipyard because of their regular 15-year surveys. So if you go back 15 years ago, a lot of ships were built, and 2025 is the year that they have to go through what is called their dry docking, their normal inspection, the special surveys. Do you think, do you model that? Do you think that's going to have an effect on the supply of ships, especially in the first half of the year? That's for Serena. I think she's muted.
Sorry, guys. Yeah, no, it's interesting. Thanks for the question, because we got the same question from a client a few days ago. Actually, we tracked, as you mentioned, the fact that there were many deliveries like 15 years ago. So the special survey for that slice of the vessels, yeah, I confirm it's higher than in the past years. But if you look at the combined picture with all the rest of the special surveys, 5 years, 10 years, 20 years, 25 years, it reached a peak in 2024, and it's going slightly down in 2025. So it's actually an interesting question, and thanks for that. But actually, I think for the supply story, what what really matters is that if you look at 2025, we see an important divergence between the Cape-size vessels and the rest of the fleet in terms of new building deliveries. That's a little bit the story on supply I would focus on for 2025. If you look at the number of deliveries on Capes, it's gonna be the lowest in 6 years in 2025. And if you combine this with the positive demand overview that I was illustrating earlier, it's surely, at least it should be positive for freight rates on Capesize, and we can expect the Capes to be the main freight driver next year. On the other hand, if you look at what's going to happen on the smaller vessel sizes, the picture is completely the opposite, because the number of deliveries is very close to the maximum level reached over the last 9 years. It's a high number, and it's combined with a picture on demand which is not as supportive as for the Capes. So that's the main focus I would put for the supply story in 2025, actually.
All right. And another very specific question on the demand side. I mean, I think we'll be talking in the next few years, we'll be talking about the new iron ore coming out of Simandou in West Africa. So I want to turn to Liz. The question is that obviously is a lot of iron ore. Yet, a few days ago, Vale said that they're looking at kind of flattish type of iron ore demand. Do you think the new iron ore is going to be replacing, let's say, lower quality iron ore? How do you model the 120 million tons coming out of West Africa, where it's going to go?
Thank you, John, for the question. Yes, I mean, Simandou is the largest untapped reserve of high-grade hematite fines in the world. So once it fully ramps up, you're right, 120 million tons is their capacity, and it will make Guinea into the third largest exporter and producer of iron ore in the world. So this actually aligns with China's strategic goal of diversifying its supplier. So we will see a massive flow into China for sure. And on the other hand, just like you mentioned, with the industry's push for decarbonization, those higher grade materials like Simandou's ore will play a vital role in the coming few years in the iron ore market. Simandou's entry will displace some of the volumes, of course. In CRU, we have a VIU-based cost curve. So our model shows that those who are sitting on the high end of cost curve with the high cost producers, such as those in Australia, some of them in Brazil, and some of the marginal cost producers in West Africa. And let's not forget about the domestic production in China will be replaced by Simandou. So another thing is that from the freight perspective, I think all of us touched a little bit on that topic, is the increase of ton miles. I totally agree. But on the other hand, is that it will introduce new seasonality to the market as well, because traditionally Q1 is the low season for Capes because of the cyclone season and heavy rainfall in North Brazil. But when Simandou ramps up, it will likely to mirror the seasonality we have seen for bauxite shipments, which means their peak rainfall season is from June to October. Rainfall volume is twice as much as that in northern Brazil, and the miners may maximize their shipments during the dry season. Then we will have a lot of iron ore availability during Q1. So the lower Q1 may become less and less obvious in the coming few years.
Excellent. So we're a few minutes ahead of time. So very quickly, obviously, we're running the risk here of having another wild year in 2025 that can throw away any prediction about rates. But 2024, probably Cape-size rates are going to average around 23,000. The futures today tell us that next year rates are going to average around 18,000. So I want to go around and ask, what do you think about this number? 18,000 for Capes, about 11,000 call it for Panamaxes. Do you think this is a low number, high number? And what do you predict for next year based on this? And I'm going to go ahead, start with Burak.
Yeah, sure. I think, I'm slightly more positive about Capes. I think they could average slightly higher. My expectation is roughly about, 19 to $21,000 range. I think we could be surprised to the upside as Liz was mentioning. I think Q1 the Cape curve is becoming a lot more flat, so we could be surprised in Q1. In terms of Panamax's about 12K, I think that might be challenged a little bit, um, mainly because of the supply side issue. We've got the market is already oversupplied, and we have more ships delivering next year. That's my concern.
Okay, Jeff, what do you think? 18 and 10, higher, lower next year?
I think lower. I think the main problem for the Capesize market isn't actually the Capesize market itself, but it's Panamax's. I think Panamax segment is really going to get wrecked next year, particularly during the first half of the year. What we've been seeing for the past 3 weeks in particular is that every time Capesize rates attempt a rally, and there have been some very, very brief, impressive Capesize rallies, just almost as soon as the rally begins, Capesize rates come crashing down again, and they're really being pulled down by Panamax rates. With Panamax rates as weak as they are, I think they're going to continue to weaken. There's too many Panamax vessels in the spot market. Grain trade is in contraction. Steel production outside of China is in contraction. The global economy is weak. I think Panamax rates are going to suffer greatly, and that really is just going to pull down Capesize rates or keep a lid on Capesize rates.
All right, Serena?
Look, my opinion is that in 2024, we have observed, as someone already mentioned, very low congestion levels on Capesizes. And therefore, what we may see if the congestion go back to normality in 2025 is a wider volatility. And also, in terms of levels, I think everything is more or less aligned for Capes to perform better than they did in 2024, in the sense that we have a supply story. We have iron ore and bauxite trades, which should be pushing. So we are rather positive at IFCOR Galbraith in terms of Capesize rates. The only risk may be the fact that let's say the fact that with the iron ore project at Onslow in Australia and at Simandou in Guinea using transhippers there, we may assist to windows of opportunity for arbitrage with the smaller vessels. And in this respect, Capesize might be challenged by Panamaxes, for example.
Okay. And Liz, finally, what do you think?
I'm sorry I cannot comment too much about the Capesize freight rate. I used to be a shipping analyst, but I'm not now an iron ore analyst. But something I can share is from the iron ore trade flow perspective is that we expect next year to be relatively flat compared with 2024. Just to a quick comment on what Serena mentioned about the ramp up of Onslow. Yes, there will be a lot of more iron ore coming out of Australia, but at the same time, there are some mines depleting at the same time. So, and in terms of Simandou, it will take years to be fully ramped up. You will not just push 120 million tons of volume into the market all of a sudden. So, 2025, I don't think there will be too much change, but let's say if Simandou ramps up as scheduled, then 2026 will be a very interesting year to watch.
Excellent. All right. Thank you, everyone, for the very honest and brave predictions here. And we're going to be back in 15 short seconds with our tanker segment. Welcome back. Our next hour focuses on tankers. Over the past year, tankers have been less volatile than one would have expected, given all the geopolitical turmoil that directly affects oil flows and oil routes. Yet VLCCs, which are the large oil carriers, have been unusually quiet. Even the product carriers, which are the ships that transport gasoline and diesel, have recently weakened marketably. Yet the Red Sea, one of the most important passages in the world, remains restricted. Russian oil is sanctioned, but not much has changed in terms of trade. Now, why is that, and how come such major events are not affecting freight rates for tankers? Now, more importantly, as we enter 2025, what we're going to see in the current flattish environment? Fundamentally, the tanker market looks promising. However, with so much uncertainty, what impact those events might play on the near-term outlook? So now, with no further delay, I would like to introduce our next segment that focuses on the current state of the crude tanker market, and primarily on the large carriers, the very large crude carriers, as VLCCs as they're called, that drive tanker demand and the outlook for next year. So we're very excited to have with us our next presenter, who has been a key voice in the shipping markets for tankers, with her timely and very thoughtful presentations. As the global head of research for Tankers International, Mette Fredriksen is providing some of the best content and outlook for the crude tanker markets. Now, for those who don't know, Tankers International is the largest pool of super tankers in the world. So from where Mette sits, she can really see and understand a lot of the drivers of today's crude tanker and oil flows. So joining us today live from London, I want to welcome Mette, who will provide us with her views and outlook for the tanker market. Hi, Mette, the floor is yours.
John, thank you very much. I'm just waiting for my presentation to come up. Is there any way for me to see it a bit bigger, or is that how we go?
Yeah, I think you can ask for them to change the slides.
Okay, I've got my own slides here. All right, so yeah, thank you very much for inviting me to chat to everyone today. And as you mentioned, at TI, we run a VLCC pool. So my presentation today will be focused on the VLCC market. But a lot of the topics I will touch upon will, of course, impact across the tanker market. So I'm sure my colleagues on the panel afterwards can maybe share a little bit more detail on how it impacts some of the other tanker segments. So if I can have my first slide, please. First, I just want to take you back 12 months. And if you had met me at a conference or out and about 12 months ago and asked me, what is the VLCC market going to do in 2024, I would have been incredibly positive. And I would have probably said that we are on the cusp of something great. We're on the cusp of a market change. The fundamentals were pointing to a very solid market, and I've included some of those factors here. First of all, oil demand from all the key agencies were pointing towards very solid oil demand growth in 2024, and this was going to be driven by China and other demand centers in the Far East. We had while OPEC were still curbing production, we have non-OPEC production growth forecasts at very solid levels. And most of this was centered west of the Suez Canal. We had Venezuelan barrels coming back into the market and back into the mainstream tanker fleet away from the dark trading. And we had so many geopolitical events that were creating inefficiencies in the market. And all of these elements were lined up to drive ton-mile demand further and vessel demand up. In particular, those long ton miles from the west to the east. At the same time, we had a VLCC fleet that was aging quickly, and we had no real replacement tonnage in the order books. The order book was at historically low levels, so we were in a situation where we had an outlook with ton-mile demand set to go up. The supply side of the equation was flat to declining. And any basic principles of supply and demand would then tell you that the freight market or the price of freight would go up on this basis. But as you mentioned, John, this of course did not quite play out as we all expected. And in the next couple of slides, I'll go through, try and put some context to why it didn't happen the way we planned it to, or the way we thought it might. So if I can have the next slide, please. If we first take a look at oil demand growth, On the chart on the left, I've shown the key forecasting agencies and what their demand growth outlook looked like if we go back to January of this year. Those are your grey bars on the chart on the left. And I've also on the blue bars included what that same growth forecast looks like today. And we can see across all of the different agencies, we have a reduction in the demand growth outlook for 2024 of about 400,000 barrels a day. So that's 400,000 barrels a day that has not needed moving on oil tankers, and 400,000 barrels a day that 400,000 barrels worth of ton-mile demand that has been removed from our initial outlook for vessel demand for 2024. On the second chart, we can see how the revisions to the global oil demand growth outlook correlates very strongly to revisions for the Chinese demand outlook in 2024. And in particular, from the summer onwards, we started hearing reports from China that the economy wasn't growing as fast as they expected. This was impacting oil demand, and oil imports were slowing down. We started hearing about faster than expected shift to non-oil transportation fuels. So that was an increase in electric vehicle sales and an increased use of LNG in trucks, for example. And all of that put downward pressure on the oil demand situation in China. But I think one thing we need to keep in mind that even if growth rates are slowing down, we are still seeing growth, both globally and in China. And looking ahead into 2025, which if we return to the left-hand slide or left-hand chart, we can see that the average growth expectations for next year comes out at 1.2 million barrels a day. And that's actually pretty much in line with long-term growth averages globally. So in terms of oil demand growth, it's not as bad as it might appear. So on the next slide, please, we can zero in on China. And one of the questions that I'm being asked all the time, what is happening in China? So I think in terms of China's impact on the VLCC market in 2024, it's been twofold. So firstly, as we saw on the previous slide, growth has been slower than we thought it was going to be at the start of the year. And secondly, in 2024, we've seen China taking more and more oil from sanctioned countries. And that, of course, is oil that is then carried on dark vessels, and we don't see the benefit of this trade in the mainstream tanker markets. So on the left-hand chart here, we can see that 2.7 million barrels a day of China's seaborne imports are coming from sanctioned origins. So since Europe started taking the Russian oil, we've seen more of that sanctioned oil flowing into China. This is mostly delivered on smaller tankers, so we don't have a direct impact on the VLCC market. China also continues to take a small amount of oil from Venezuela, but the most significant impact this year has been a big rise in Iranian oil flowing into China. So this is both oil directly from Iran, but also the barrels that are branded as Malaysian blend and is lifted off of Malaysia and going into China. But all of this trade is happening outside of the mainstream tanker markets. In 2024, this has averaged 1.2 million barrels a day. So that is quite a lot of flow that does not sit within the mainstream fleet. And on the right-hand chart, I'll try and show the shadow fleet activity into China. And we can see, especially in the lighter blue bars, the trade from Iran into China has increased significantly in 2024. And then on an annualized basis, this year we see 250 VLCC fixtures going into China with sanctioned oil. So this is about 20 fixtures per month that is taken away from the mainstream tanker markets. And is this likely to change going into 2025? It's difficult to say. We have heard reports in the last few weeks that Chinese refiners are facing more pressure to reduce their reliance on Iranian oil. This is due to tougher US sanctions and also because of rising costs. But because the Chinese buying patterns depend on so many different factors, including price point, government policy, we can't say for certain that if this Iranian oil, for example, was not available to China, that they would replace it barrel for barrel with unsanctioned stuff. Some of the more encouraging developments we've seen in the last month or so is more Chinese buying of other Middle Eastern grades and also a bit more buying of West African grades. And if I look at my VLCC fixture database, in November, I saw a big spike in fixtures into China from the US and from Brazil, for example. And this is some of the ton miles that we have been missing from the mainstream tanker markets, especially from the summer and into the third quarter. Next slide, please. So another big story in the news, of course, is OPEC Plus and their plan to reintroduce 2.2 million barrels of voluntary production cuts back into the market. Saudi Arabia has been losing market share to producers in the US, for example. And if they choose to move away from a price target strategy to try and claw back some of this market share, that's where we can see some of these voluntary cuts coming back into the market. They've tried to, or they've planned to reintroduce these 2.2 million barrels on a number of occasions this year, and I believe today it was pushed back by another quarter. But in the middle chart here, I show by region where the current voluntary cuts are located. And we can see that the majority of this is actually located in the Arabian Gulf. That is the large dark blue segment on the bottom of the middle chart there. And just to try and translate this dark blue segment into a potential impact on the VLCC market, we calculate a cumulative effect of 55 VLCCs in full-time employment. So that means if all of this Arabian Gulf volume was to move on VLCCs from the Middle East to the Far East on VLCCs, it would employ an additional 55 VLCCs. Of course, it might not all go on VLCCs, and we would also need the demand base in the Far East to take this volume. But I think it's still quite an interesting number to include here, just to show how much of an impact these cuts have on the VLCC market and how much they've impacted the VLCC market since they've been in place. Next slide, please. So while OPEC Plus have continued to curb their production, non-OPEC producers continue to show big expansions. But looking back 12 months, the outlook for non-OPEC production growth for 2024 was 1.2 million barrels a day. That has since been adjusted down to 0.7 million barrels a day. Most of this adjustment came from Brazil not realizing the expansion plans that we expected a year ago, and we've also seen fewer exports from the US. And again, if we try and bring this back to ton miles and demand for VLCCs, with China not drawing as many mainstream barrels from the Atlantic basin, that has left Atlantic exports staying within the region west of Suez, which of course means shorter distances traveled And it also, for the VLCC segment, means more competition from the smaller tankers that traditionally operate within these more localized markets. So again, this has added downward pressure to VLCC demand in 2024. So looking ahead to 2025, current projections peg non-OPEC production growth at 1.6 million barrels a day, and about 1.3 million barrels of this is located west of Suez. And then on the next slide, please, we can see how the geographical split between supply and demand looks in 2025. So here we can see the expected supply growth in the blue bars being centered in the west of Suez market, while demand growth in the green bars is centered in the east of Suez markets. So this scenario, in theory, should drive oil flows from the west to the east. And these long-range trades are traditionally a VLCC market, and this should provide a lot of support for the VLCC market in 2025. In terms of how much extra demand, I think we can use the lower of these two numbers. So that's about 1.1 million barrels of demand growth expected in the Far East. And if we assume that all of that comes from the west of Suez suppliers, we could see extra demand for about 30 to 35 VLCCs based on this trade alone. Again, this is perhaps a best case scenario, but it does tell you a story about how important these long range ton miles are for the VLCC segment. And even if just a fraction of this was to materialize, it could be the swing factor that the market needs to see a sustained growth in ton miles and create that turn in the tanker market that we're all waiting for. Next slide, please. So going back to 2024 and ton mile development as it's happened this year. The blue chart on the left, I show a 5-year range for VLCC demand globally. That's the blue area there. The blue line is how it developed in 2023, and the red line is how it looks in 2024 year to date. And overall, demand this year is down by about 3.5% versus 2023 levels. I should mention that I've excluded all sanction trades from these charts. So in 2024, we can also see the unseasonal decline in demand in September and October, followed by an uptick in November. With China being such a big driver of VLCC demand, I've also added the green chart here, which shows the same data, but based on Chinese demand only. And here I see two things. So firstly, demand this year has been trading low, especially from the summer onwards, before it shoots up in November, mirroring the global demand picture. So China is likely one of the key drivers of the global uptick in November. Secondly, I've included a yellow line here, which shows you China's demand for VLCCs, but including all of the sanction trades that the market has seen. And we see a big gap between the yellow and the red line through most of the year. But in November, we see that gap narrowing quite closely. So this, of course, coincides with all the reports we've been hearing about China pulling away from the sanctioned Iranian business and utilizing more mainstream vessels. Whether this is a development that's purely down to price points, or whether they are indeed trying to align themselves with Western sanctions, remains to be seen. This is one data point, so I don't think we can draw any any final conclusions from that just yet. So on the next slide, please. So on this slide, I just wanted to add a quick example of how some of the geopolitical events across the world are impacting ton miles and through inefficiencies in the market. A big one this year has been the closure of the Suez Canal, which has forced most mainstream tanker owners to avoid the Red Sea and avoid the Suez Canal. And when traveling or when carrying a cargo from the Middle East to Europe, you now have to go via the Cape of Good Hope rather than through the Suez Canal. This adds about 15 days to your laden voyage for a VLCC. So on the left-hand chart, we can see how fixtures have gone from traveling almost exclusively through the Suez Canal. That's your lighter blue bars on the chart on the left. But from the beginning of this year, the VLCC fixtures are now trading almost exclusively on the longer route via the Cape of Good Hope. And in terms of an impact on ton miles and vessel demand, the right-hand chart shows an increase in vessel demand of about 10 VLCC equivalent based on this inefficiency in the market alone. So the next slide, please. So lastly, I just wanted to talk about the supply side of the VLCC market. The order book remains fairly low at 80 vessels. This is about 8% of the trading fleet. And even though we continue to see additions to the order book, the delivery schedule over the next 4 years remains below the 10-year average. And when talking fleet development, we also need to look at the older part of the fleet, and the fleet is definitely aging. The average age of the VLCC fleet today is about 12 years old, and we have to go back more than 20 years to see a fleet profile with the same sort of average age. The chart in the middle really tells the story here, and we can see that the number of ships surpassing 20 years of age has grown rapidly over the last 4 or 5 years, from having only a handful of ships in that age bracket to now having about 100 ships or more than 100 ships even. And if we go forward another 4 years, we'll have 200 ships that are aged 20 years or older. And this is 21% of the trading fleet. And comparing this to an order book of just 80 vessels, it leaves a huge gap there. So another thing to keep in mind is that these older vessels, even if they still find employment, are nowhere near as efficient as their modern counterparts. So on the right-hand chart, I show the average number of voyages for a vessel based on the age group on the x-axis. So here we can see that a normal modern VLCC will perform about 5 voyages in a year. That's when they have very few trading restrictions. They can pretty much trade around the world. When we go into the 15 to 19 year age group, the ships tend to trade a little bit more in the Far East, where the voyages tend to be shorter, and they perform about 6 voyages in a year. But then from the age of 20, the utilization just drops almost immediately to 0, especially if you look at the lighter blue line, which excludes any sanctioned trading. If we look at the darker blue line, we can see that it's within the dark fleet that these older vessels continue to find employment, but still at much lower utilization rates than their modern counterparts. So going forward, even if we might see additions to the fleet in terms of unit numbers from the new buildings coming in, if we added utilization factors to the older part of the fleet, the effective fleet will actually decline over the next few years. So the next slide, please. So to summarize, fundamentals in 2024 did not live up to expectations. It was almost a situation where many small events added up to have a cumulative effect on the market, which meant that the VLCC market didn't have a chance to boom in the way that we had expected it to. And in terms of the fundamentals going into 2025, not much has changed. We still have non-OPEC supply coming with pretty strong numbers. We have the potential for OPEC to come back with a significant volume, and the world continues to face geopolitical challenges that create inefficiencies in the market. And we have a fleet that's not growing. If anything, it is going to decline if you take into account the utilization factor. But of course, for all these positive factors to turn into actual VLCC demand, a crucial element is China. And China, both in terms of realizing the demand growth that is expected from China, but also in terms of where they choose to source their oil from going into 2025. Another factor that I've not wanted to place any bets on today, of course, is what is going to happen when Trump comes back into power. We've seen before he can be quite unpredictable, to say the least. So for the time being, I've left him hanging there like a bit of a wild card that could swing either way to either side of the scales. But I think overall, if you were to catch me out and about at a conference at some Christmas drinks later this week or next week, I'll still be standing there waving the flag, the bull flag for the VLCC market. Based on the fundamentals, I still think that 2025 looks positive, and I think freight in 2025 is going to be better than it was in 2024. And with that, I will pass back to John. Thank you.
Thank you, Mette. That's very interesting. And I'm gonna ask another Christmas cocktail question, if I might. And OPEC today obviously came up with their decision. They seem as a very united organization at this point. I mean, they're delaying obviously the barrels into the market, and that's marginally, I would say, negative for tankers. On the other hand, you have this argument of like having exports, oil exports, barrels coming in the Atlantic basin, whether that's the US or South America, and that's very helpful for the demand for tankers because you need more tankers to transport the same amount of oil. My question is this, like, if you had to choose between more barrels out of the Middle East versus barrels out of the Atlantic, which of the two do you think helps more the VLCC market? And why I'm asking this question is that there is this argument out there that, OPEC might at some point decide to stop defending price and go for market share, which means much more oil will come to the market out of the Middle East. And less obviously from the Atlantic basins, that's higher cost. What do you think about this argument? And again, that's obviously an imaginary scenario here, but I want to hear your thoughts.
Yeah, that's an interesting question. I think more oil in the market in general is positive for the VLCC market. But as I think I mentioned, one crucial element in any scenario is that we need the demand base to come back. What has disappointed in 2024 is the demand base. There's been plenty of oil in the markets, which is also why OPEC have been holding back on reintroducing all these voluntary production cuts. We need demand, especially in the Far East, to come back to the levels that all the agencies are forecasting. Obviously, from a ton-mile perspective, having that demand being satisfied by Atlantic basin barrels would be better, but at the moment that's the unknown. The demand side is the unknown.
Makes absolute sense. All right, thank you very much for your time, Mette. That was extremely interesting. And indeed, it seems that we're going back to more traditional supply-demand models here, given the low volatility. But again, I have a hard time believing that with all the turbulence in the Middle East and OPEC being always a wild card, we're going to continue to have such a low volatility type of environment for tankers. So we'll be right back for our second panel of the day in 15 short seconds. Welcome back. Our last segment of the day also focuses on tankers. As we heard from Meta's presentation, there is a lot of uncertainty from geopolitics to tariffs to OPEC and obviously demand. And all this is very relevant for the oil-dependent tanker sector. However, there is more than that, and hopefully our next panel is going to shed some light on all these factors. For that panel, I'm going to go back to Athens and my colleague Thanos Ophios, who will moderate our next panel on tankers. Thano, good afternoon from New York. The floor is yours. Please go ahead.
Good afternoon, John. Thank you. Once again, the global oil market has entered a new phase of uncharted territory, characterized by significant supply and demand side risks. We are glad to have with us four distinguished guests who have followed tanker shipping for many years and still focus on a daily basis on every aspect of it. They will provide us with their views on the current state of the tanker market and give us their outlook for next year. Our panel today includes Anastasia Zanya, lead tanker analyst at Energy Aspects, joining from London. Nadia Martin Vigen, director at Sveland Capital, joining from Oslo. Jonathan Staubo, oil tankers advisors at Fernleys, joining from Oslo. And Richard Matthews, consultancy and research director at Gibson Shipbrokers, joining from London. So let's get started. We will have 3 rounds of questions. The first question is pretty basic, but as it is in everyone's mind, I will go around and ask the same thing to all panelists. First to Nadia. The crude tanker market has underperformed in 2024, despite a lot of geopolitical turmoil. Why is that? What do you think, Nadia, is the catalyst for a turnaround in 2025?
Thank you. So just very quickly, I mean, the geopolitical turmoil we experienced didn't benefit the crude market because it was the closure of Suez, and we do not have that much crude flowing up to Europe. It's more of a product trade. Then we look at the refinery outages in Russia, and then that meant that there was additional crude exported out of Russia, but as we heard in the presentation, that went on to the shadow fleet. So it did not benefit the tanker market. When we look at the demand disappointment this year, and I agree with what the first speaker said, we actually have experienced negative Chinese apparent demand growth. So that when we think about the shipping side, we've actually drawn stocks. We think in the fourth quarter, we'll see real demand growth in China, but that's coming from stocks rather than from flows. When we look at what the rest of the region did, we had some growth in India, 200,000 barrels per day. We had 500,000 barrels per day from the rest of non-OECD Asia. But we had 400,000 barrels per day of growth within the Middle East. And that's not exactly a huge ton-mile opportunity for the tanker market. When we look towards next year, we expect China to actually show some growth, so 300,000 barrels per day. So that's a flip of 400,000 barrels per day, which is a big difference versus that general growth period. We only see the Middle East growing 100,000 barrels per day. So that's just on the pure oil demand side. Now, what can really stimulate this market going forward is if we have these sanctions coming onto Iran in such a way that China stops buying Iranian crude. We believe that OPEC has the spare capacity. Saudi Arabia can put on that crude instead, but then that would go in the shadow fleet, which currently uses up 24% of the available tonnage in the world. So that is a big flip if that were to come into the normal market. In addition, the Trump administration could actually enforce sanctions on Russia if they wanted Putin to bend more on the situation in Ukraine. And that could, again, use up tonnage in the normal market. However, it's a difficult negotiation with China because China has to agree to this. And the only way we see that can happen as Felling Capital is through a tariff agreement that the US will tariff China less. The other situation is if we have OPEC just fall apart completely in terms of their united front versus what they're talking about right now, and they decide to bring more oil into the market. We expect in that scenario, the oil price to come down, and that lower oil price can stimulate additional demand and help us find a floor. But that is a rocky way to move things forward. Thank you.
Thanks, Nadia. Richard, what are your thoughts? What went wrong in 2024 and how do you view 2025?
Well, I think Meta and Nadia have covered a lot of the points already, so it's going to get harder as we go through this panel to come up with new answers. But look, from my perspective, it's not been supply driven this year. As we know, the supply side of ships has not grown in the VLCCs. I think we've had one new building deliver. We've had 28 ships turn 20 years old this year, so the size of the modern fleet has shrunk. So it's not been a supply problem. It's been all about demand. So when we look at China, as we just heard, Chinese crude imports have declined this year. We're tracking it down by about 200,000 barrels per day. But actually, they've taken more Middle Eastern crude this year. They've taken more sanctioned crude, as Mehdi said, and they've cut their imports from the Atlantic Basin. Now, what that's meant is that although their demand has fallen, their ton-mile demand impact has been even greater. So that's why this year has certainly underperformed in my mind. As we go into next year, as we said, Chinese demand is going to be key. I'm not hugely optimistic when we see the structural changes taking place in China, be that LNG trucking, which is displacing up to around about 400,000 barrels per day of oil demand next year, or be that the increase in EV penetration as well. So I think Chinese demand will remain constrained. I also think as well that when you look at Chinese demand, people look at total oil demand, but that includes LPG and ethane, and that's not going on crude tankers, right? So it's, again, what's the actual crude oil demand going to China? So I think next year, this will be the key challenge. But what we do know, again, as Mehdi explained very clearly, is that the supply of oil is increasing substantially next year. And when I look at the balances for next year in the oil market, it doesn't balance. It doesn't add up, right? There's too much oil coming. There's not enough demand. So demand has to either be higher than expected, or oil supply has to correct lower. Or we see a contango and we see storage opportunities. And then, of course, as already mentioned about, the uncertainty is massive right now. We're talking to our clients and saying, look, we need to see Trump in the White House. We need to see what his first 100 days look like, what the implications are for Iran, what the implications are for Russia, Ukraine, and then we can start to make a strategy from there. So huge amount of uncertainty, but my biggest fear factor next year is on the Chinese demand side, particularly when we're talking about the VLCCs.
Thanks, Richard. Anastasia, on you. Almost everybody expected a much stronger 2024, and the year was rather disappointing. How was this year in your view, and what 2025 looks like?
First of all, I think the general market disappointment stems mostly from the second half of the year. Rates in the first half for the main routes and for different sectors that were significantly above their 5-year average. So it's just that since the summer, it seems like it has been the perfect storm. We've been having persistently weak refining margins, and as everyone has mentioned already, Chinese demand underperforming massively. We had a very heavy refinery maintenance this year. Much lower than expected production growth in the Atlantic, mostly from Brazil and the US, which means that we had less crude exports out of the Atlantic Basin. And all of this, with all the seasonal factors for Q3, they have contributed to the downtrend that we're seeing. And mind you that this was in a year of pretty much of minimal fleet growth for the crude tanker sector. Now, going into 2025, I would agree with everyone that it's a demand issue, and that's what I wanted to point out here, that fundamentally, I'm going to ignore all the noise around, not noise, but like all the uncertainties around the new US administration, geopolitical, etc. And like fundamentally, we're a little bit more constructive on VLCCs versus Aframaxes and Suezmaxes on the back of the upcoming changes on the refining landscape. Next year, we expect runs growth to pivot back towards Asia, and we have Asian growth leading global runs growth in 2025 on about 0.6 million barrels per day of net capacity additions. And on the other hand, we have global refinery closures reaching 1.2 million barrels per day by the end of the year. And from that number, 2/3 are in the US and Europe. So again, if you look at the fundamentals, we have the demand for crude rising in the East and our expectations of production growth driven by the Americas, US, Brazil, Guyana, Canada. So you would expect more west to east flows to boost ton-mile demand and support primarily VLCCs. However, as Matt also pointed out, non-OPEC production growth risks are more skewed to the downside, especially Brazil and then the US. They have massively underperformed, I think, not only ours, but general consensus expectations for this year. And another point is that most of the startups are mostly concentrated on the second half of the year. Now, for the smaller segments, Suezmaxes and Aframaxes, because of those refinery closures that I mentioned, we're talking about like around 800,000 barrels per day of refinery capacity closing in the Atlantic. And if you add on this some refinery startups in oil-producing regions like Dangote and Dos Bocas, then it's very likely that this will weigh on the demand for Suezmaxes and Aframaxes next year.
Yeah, thanks, Anastasia. Jonathan, what do you foresee 2025 will bring versus 2024?
I think that the main difference as we see it going into next year is much higher expected production growth. And when you look at this historically, production growth is the driver of crude tanker demand. It's not really, when you look at oil demand versus oil supply, it's clearly oil supply driving it. And yes, there's potential downside risks to the supply forecasts from non-OPEC. And as Anastasia correctly mentioned, it's been disappointing, especially in Brazil this year. A few more FPSOs coming on there next year. And hopefully that should give a bit more actual supply growth from Brazil. But even if supply surprises to the downside from the most recent West of Suez estimate from the IEA is 1.8 million barrels per day. So even if it's 1.4, that's nearly 4% volume growth for the crude tanker market, assuming that all those volumes are shipped. But for most of these regions, that is likely to be shipped. So I think that's a much bigger tanker demand push next year than we've had this year. And hopefully we'll see some more constructive development from China. I think I agree with Nadia that there are some signs of improvement now going into the fourth quarter. Clearly, refinery margins are improving. You're seeing the industrial activity picking back up. And one other thing to mention is that this year, the Chinese inventory capacity has hardly built at all. Next year, there is more than 100 million barrels of capacity coming on. And if we then go into a market that's oversupplied and a contango structure in the forward curve, that would incentivize more inventory builds. So this year, there hasn't been a lot of inventory builds in China, which is a change from the last 10 years when on average there's been substantial inventory builds there. So one thing that could contribute positively.
Thank you. Thank you, Jonathan, and thank you all. This concludes the first round of questions. It was very insightful. The International Energy Agency, in its recent oil market report, highlights that the world oil demand is forecast to expand by just shy of 1 million barrels per day in 2025. According to the agency, the slowdown in growth from recent years reflects the end of the post-pandemic release of pent-up demand and below-par underlying global economic conditions, as well as clean energy technology deployment. What is your outlook regarding the demand for crude oil? Richard, I turn to you for this one, and I kindly ask you to elaborate a bit more on the demand side. Thank you.
Sure. So we're generally working with a figure just above what the IEA are using for next year, so about 1.1 million barrels per day. As we said, when we look at the composition of that demand, about 60% of that demand is in Asia. So, of course, you have India growing next year. Even though our expectations are lower, you have Chinese growth still coming in next year as well. We expect to see Chinese refining runs increase by about 300,000 barrels per day. next year. So although we're still conservative with China, again, we do still expect to see demand growth coming into play there. Elsewhere, of course, in India, again, we see increases in Indian demand growth. So we're positive there for the impact on the tanker market in general. But our concern there is that India has been the biggest buyer of Russian crude. So we're not sure how much additional incremental growth outside of the sanctioned barrels as such will take place in India. There is some limited demand growth in the Middle East, and generally speaking, we talk about tankers. We're never optimistic when we see Middle East demand growth because that eats into either crude or product exports from the region overall. Elsewhere, of course, in Europe and places in the West, we may well see some declines in demand. But again, we're not overly concerned there when it comes to an impact talking about crude tankers and VLCCs. Though I suppose our concern going into next year is that this year we've seen demand growth be consistently revised down. And again, if we're overestimating next year, then we've got some challenges coming up. So again, sensitivity factors here, for example, penetration of LNG trucks in China, that's eating into diesel demand of about 400,000 barrels per day, depending on whose figures you believe. If we weren't to have that demand growth next year, then our demand growth rates in China would look a bit more normal as such. And then again, one thing we're carefully watching at the moment is when we talked a lot about oil supply and how much supply is coming online, as has just been alluded to, there is far more supply coming online next year than there is demand. Now, of course, if that happens, that supply still has to go somewhere. Whether that means that it forces prices lower and actually we revise our demand estimates up because of lower prices, or as Jonathan said, whether that goes into storage, again, for next year at least, that's all potentially additional seaborne tanker flows. So yeah, there's still reasons to be optimistic next year. Most of the news we get, of course, is doom and gloom that comes out typically. But when you look at the amount of supply coming into the market and you look at demand of 1 million barrels per day, again, as Meta said, that's not bad demand. It's just not what we've been used to over the past few years. It's closer to the long-term averages. So we have something to work with. We're not hugely concerned, but again, there's reason to be cautious as such.
Thanks, Richard. Of course, tanker freight rates are driven by the demand for crude oil and the supply of available tankers to transfer it. Anastasia, building on Meta's presentation, how does the supply side look like? What is the current size of the order book? And could we see a pickup?
I think Meta covered it, especially for the VLCC sector. From a supply perspective, the market is very well placed for another year in 2025, especially if demolition was to pick up. We have only 5 VLCCs scheduled to hit the water in 2025. So even if we were to assume that all 5 will be delivered, then we will see 0 demolitions. The maximum fleet capacity, the maximum fleet growth that we can see, it will be around 0.5%, best case scenario. Demolitions is key. Multi-year load deliveries and minimal to, I will say, close to inexistent demolitions due to employment opportunities for the older tonnage. They have increased significantly the age profile of the entire fleet, not only VLCCs, and this has created a pent-up demand for demolition candidates. We estimate that about 80% of the existing VLCC fleet is over 20 years old. And if we account for the single VLCC that was delivered earlier this year and the 5 that we expect in 2025, these are far outweighed by the over 150 vessels that will be above the 20-year-old mark by the end of 2025. In terms of ordering activity, we did see a surge, especially for VLCCs this year, and mostly in the first quarter. We started the year with a VLCC order book accounting for less than 3% of the existing fleet, and right now we're standing at 8.5%. This came from like a few high-profile owners investing in the sector, particularly in January, February, and that created an influx of new orders, especially compared to the past 3 years. Just to put it into perspective, this year's VLCC orders, they are the total of the past 3 years, essentially. So we're talking about like quite big numbers here, but still quite below compared to historical averages. We are a bit skeptical on the repetition of this year's high ordering activity, as lead times now they're extending well into 2028, which could potentially disincentivize some owners to commit to such an investment, especially under the current high asset price and low freight rate environment. However, that said, ordering activity tends to correlate quite well with earnings, so we wouldn't be surprised to see an uptick in ordering activity once earnings rise. In the longer term, though, there is some optimism in general for the tanker fleet growth overall, not only VLCCs, and that's due to the increased demolition candidates that I mentioned before, shrinking yard capacity, and also yards' preference for higher margin projects that we have seen them prioritizing LNG carriers, and containers over tankers. Thank you.
Thanks, Anastasia. Now I would like to move to a subject that is expected to unfold gradually. Jonathan, this one is for you. What would be the impact of the new US administration on the shadow market? For those of you not familiar with the term, the shadow market or the shadow fleet, also referred to as the dark fleet, is the fleet of tankers that use concealing tactics to smuggle sanctioned oil. Jonathan?
It's a difficult one where we obviously don't know what's going to happen. But looking at everyone that's been hired by Trump so far, it's more hawkish in terms of their expected approach toward Iran. It's expected to see increased pressure, and we already have now, the last month, seen a lot more vessels being placed on the OFAC sanction list. So even the Biden administration has started to take this more seriously. So it's something that's expected to continue. We've, as already mentioned earlier, seen that Chinese teapots have started buying oil from other sources than Iran most recently, partly also because the discount for Iranian oil is so much smaller now than it has been in the past, so it's not worth taking the risk anymore. But I think all else equal, it's unlikely that Iranian exports will increase like they have in the past. We expect to see some floating storage of Iranian oil because some of the previous buyers of those Iranian barrels will not take them anymore, will rather source from other areas. So it might leave some of the shadow fleet idled, less efficient, and overall we expect that next year all supply growth will go to the normal market, unlike what it has in this year. But more importantly, we also think that there is some downside risk for Iranian flows, and also so that means China needs to replace some of those barrels from other areas. Whether we will see any scrapping, I probably don't think so, because the scrapyards are not going to be willing to touch those ships either. So it's rather about seeing idling of ships, but less of an impact of the shadow market next week, to the negative side at least. And of course, massive upside if there is broad sanctions like in 2019 with the COSCO fleet. And there is, as Curiosa, a vessel now that was recently put on the OFAC list that's controlled by a very major operator of VLCCs. Not owned, but it just shows how difficult the landscape this is and how things may quickly become more interesting.
Absolutely. Thanks, Jonathan. I finally turn to Nadia, and I will ask her to help us with a wrap-up on geopolitics, the Middle East and Russia situations, and how do they affect the crude oil trade. Nadia?
Thank you. I think we've covered a lot on it, but just to talk about a little bit about how China and India together are key. They are members of BRICS. They are the main purchasers of this sanctioned crude. And will peace mean that everyone starts to buy crude from either the Middle East or Russia? We do not have that in our base case. And the question then to the upside is if they can be convinced to buy less. I'd say when we look at what has happened so far, China is behaving very cautiously. Yes, they're allowing more purchases by the independent refiners. They issued some more quotas in the fourth quarter now, but they're taking away from the amount of quotas that are allowed for imports in 2025. So I think the Chinese administration is very carefully waiting to see what Trump does, what that means in terms of available producers to purchase from in a free world if there were peace in Russia and in the Middle East, or a more peaceful ceasefire. But in the meantime, it's very interesting because we've had Iran go very quiet since the election result, relatively speaking, whereas we've seen Russia do the opposite. So that's what it's going to be, an actively traded market in our view, and we just have to be on top of it. Thank you.
Thank you, Nadia. And this concludes our second round of questions. Now for the end, I kept our traditional question on outlook, so here it goes. Freight futures for the very large crude carriers, the VLCCs on the benchmark route from the Middle East Gulf to China, are currently pricing 2025 at about 29,000 USD per day for the standard type of ship. Do you think spot freight rates will exceed these futures market expectations next year? Let me go around and ask you for a rough number, but also what could surprise us to either the upside or the downside. Jonathan?
Yeah, I think absolutely there's upside to that figure with 0 to potentially negative effective fleet growth and quite a lot of demand growth coming from all the supply coming in. It's very easy to fathom how rates are going to be higher than that. We think for the VLCCs, a range somewhere between $50,000 and $60,000 per day. It could under and overshoot depending on geopolitics and the macroeconomic setup and especially what may or may not unfold with the sanctions. But in any case, I think we're in for quite a bit stronger rates next year than we've had this year.
Anastasia?
I was actually trying to do the calculations now in my mind because we currently have everything in dollar per metric ton, but assuming that's around 11.9 to dollars, $12 per ton, then yes, we do think the market is currently underpriced. In terms of upside downside risk, I think we have mentioned a lot of things, but what we can all agree is that we know that we're entering a year of high volatility. There is significant uncertainty over next year, and until there is clarity on Trump administration policies, like they range from potential of tariffs to wait on global demand and efforts to boost U.S. production to potential tightening of sanctions enforcement. And we have seen how the oil market and to a lesser extent the tanker market were moving on tweets, for example, during his previous presidency. So all of these, they just add to the mix. So we do expect next year to be more volatile than what we have seen. And fundamentally, as I mentioned before, at least for the VLCC market, we think we are better placed than what the current FFA curve suggests.
Nadia?
Yeah, I think it's also interesting to look where we came from. We've had a complete collapse in those rates in the last 6 weeks, really, since, if you compare versus October, where we were in the middle of the year, yes, demand slowed down in terms of that forward curve. And everyone is viewing, when you look at the macro markets, as the Trump trade being huge tariffs, no demand, all of these kinds of things. And that's playing into that in terms of concerns on the oil curve right now. Looking forward, we think $45,000 to $50,000 a day is a good, healthy price. Upside from here, not a crazy price, but a healthy fleet for the amount of supply and demand we see going forward without complete and total trade wars that we do not believe is in Trump's interest. And he will, pick and choose and threaten. And, he likes tariffs because he doesn't need Congress. And then he can flip-flop and tweet and go the other way. So that's our view. Thank you.
Richard?
Yeah, I think that you may not want to hear it or not, I don't know, but I've never really thought that the FFA market is an accurate predictor of where the market will go. I think it's more of a reflection of current sentiment in the market. So in our view, we think the forward curve is definitely undervalued on VLCCs. We're pricing it somewhere between $40,000 and $50,000 per day next year. And that's based off of all our base case assumptions. So that's based on zero fleet growth next year, the effective supply of modern VLCC shrinking. It's based, of course, on high oil supply growth in the Americas, and it's based off that oil demand growth of just over 1 million barrels per day. Of course, what none of that factors in, which we've spoken about, is the geopolitical risk. Now, I don't buy into the whole drill baby drill thing. I don't think that's going to influence US production, but we know that Trump's foreign policies are typically quite aggressive. I do expect tougher sanctions on Iran, and I do expect that to shift some demand from Iranian trade and dark fleet onto other Middle Eastern barrels, US barrels, and non-sanctioned ships. So I think there's potential upside there as well. But I must admit, as much as I say I don't think that forward curve's an accurate prediction, the market still feels very bearish right now. I sit in the office right next to the VLCC broking desk. I hear what they're talking about today, and there's definitely a feeling that people have given up now for the year, and they'll worry about it next year. So we've got to see how the first 100 days go, whether we revise that forecast or not. But I still feel that the forward curve is too low at the moment relative to what the fundamentals say.
Okay, that was great. Thank you for being brave. I would like to thank all our panelists for being here and sharing their views. It was indeed a very interesting discussion and hopefully an informative one that provided some food for thought on the outlook for the tankers market. And with that, I will turn it now back to John in New York. John?
Thank you, Thanos. That was very interesting indeed. So I would like to thank all our panelists and presenters. And that was our last panel of the day as the sun comes out here in New York. We hope you enjoyed the discussion and are a bit wiser on those very important industries when it comes to the global economy. That concludes our Breakwave Day. Thank you all for joining us. We wish you all the best for the new year and looking forward to continue the discussion for the years to come. Enjoy the rest of your day.